Hello and welcome to Livewire's Undiscovered series, a series where we'll be shining a light on some of the market's under the radar funds. I'm Selby, and today we're very lucky to be joined by Vaughan Nelson's James Eisenman, all the way from the US, for his take on what's actually happening on the ground for small and mid-cap stocks. Thank you so much for joining us today. James, really excited to feature you on the show. What led you to launch the Global Equity Smid Fund, and what sets it apart from its peers?
Sure. So when we first launched the strategy about 4 years ago, we received some pretty immediate interest from the Australian market, both on the institutional side, but from smaller investors as well. So it became pretty apparent that the space was interesting to investors down there, but the asset class is actually very underrepresented in most portfolios for Australian investors. But it offers really great diversification benefits as well as attractive returns. And so we really saw the opportunity there to service both larger clients as well as smaller ones. And the fund format obviously is really good for some of the smaller investors in the space. I do think it's probably important for some people just to kind of define a little bit about what the SMID space or the small mid cap space is. So SMID is obviously just small and mid caps combined, but that just means we can go up further up market cap than, kind of a traditional small cap fund. So the average market cap in the benchmark, the equity SMID cap, is about 9 billion Australian dollars. So that's about the size of Sonic Healthcare. So I think people get a little confused with the small part of the name and think these are really tiny companies, but clearly they're larger, more well-established ones within the space as well. So there's only about 7 or 8 publicly traded companies within Australia that would not fit within this universe. And so the companies are, as I said, well-established, they're successful, they're profitable, and particularly the ones that we're looking at for our portfolio are a lot less volatile than the very low end of the space. In terms of what sets us apart, so we have a targeted return approach for picking stocks. We view each stock in terms of its total return potential over 3 years, not its relative return versus the benchmark. We're willing to trade time for value, so we don't mind being a bit early if we think we can hit our return target over a 2 to 3 year time horizon. And the process incorporates 3 different ways in which you can earn your return from a stock. And because of that, it allows us to move capital wherever there's the best risk reward. It also helps us from being out of favor for an extended period of time. So a manager that's a bit more style box oriented, that may be deep value or high growth, will be in favor for periods of time and out of favor for other periods of time. It allows us to be more of a core offering and move capital to whichever end of the spectrum is undervalued at a given time. So that's pretty attractive. And then we do a lot of work on risk management as well as the macro. So that really just kind of informs our stock picking, tells us whether our companies are facing headwinds or tailwinds from the macro environment. So even though we're bottom-up stock pickers, day to day, there's a lot more that goes into picking those stocks as well.
We've seen smaller mid-caps underperform their large-cap counterparts maybe over the last 12 to 18 months. That's due in the most part from the Mag 7, although they have actually recently come off too in the last maybe month. What catalysts do you think we need to see for small and mid-cap stocks to re-rate?
Sure. So no, you're absolutely. The stocks have underperformed really over the last year or so, but there's many periods where global SMIDs have actually outperformed the large cap space. And if you look over a longer term chart, kind of removing the most recent time period, they would have outperformed. We actually started to see a shift really in early March with money moving out of some of those really strong performers of the last 12 months or so and into the small and mid cap space. So some early signs of some rotation there. The smaller caps do tend to be a bit more cyclical than largers. So, if you're going after that kind of cyclical upside, it is an interesting place to deploy capital. But we actually think, the SMID universe itself is attractive and diverse enough that it can really be a core holding, and you don't need to think of it as a rotation from large to small. You can own both. You get better diversification actually within the SMID space than you do within the large space. So that they can both work at the same time. But again, we did actually start to see some early signs that maybe capital is gonna flow down towards the smaller caps.
Okay, small and mid-cap companies do offer investors growth, but that does come with slightly more volatility than those large cap, more defensive names. How do you manage that volatility yourself at Vaughan Nelson?
There's more volatility at the very low end of the market cap range, and that's not really an area where we spend a lot of time or put much capital. But it's a bit of a misconception that the Smid space as a whole is more volatile. So it's slightly more volatile than like a global large cap space. But if you compare it to Australian small caps, or really actually the ASX 300 as well, it's actually less volatile. Which was a bit surprising to me and maybe surprising to other people as well. So, the space itself, not as extremely volatile as you might think for a true kind of very, very small company. But within our portfolio specifically, we do have a bit of a higher quality bias. We focus on downside being limited when we enter a position. So the average name is going to be even less volatile than when looking at the index level. So to the extent we want to own a name that may have a lot of volatility around it, because there's times when you want to be cyclical and you actually want that upside volatility, we would just manage that with position sizing and judging the risk reward upside downside trade-off and handle it in that way.
Okay, let's get a little bit deeper into your portfolio itself. 24% of your portfolio is invested in industrials, 21% invested in consumer discretionary. Why are those sectors attractive right now?
So when we think about portfolio construction, we actually don't spend a large amount of time thinking about the specific sector in which a company sits. That can actually be a bit misleading at times. So we focus on the fundamental drivers of the industry that they're in and of that business. So the factors, if you will, that are going to drive the company. So if you look at industrials, for example, we are overweight. We've actually been overweight the entire life of the fund. But what we've owned within that sector has changed pretty dramatically over that time period. So people think of industrials as, kind of capital equipment, ground transportation in the form of trucking, many kind of capital heavy, true industrial cyclical businesses like that. But there's a big piece of that is commercial services, that's recurring revenue, that's less cyclical. So 9 months ago, we were geared towards those more recurring revenue businesses with greater visibility, more sustainability of the margins, or less volatility in the margins, and overweight industrials. And if you looked at the portfolio today, we've shifted much more to the industrials that are what you may consider a true industrial. So more cyclical, maybe trucking or less than truckload, maybe machinery or equipment oriented. But the headline, percent of your portfolio in that category really hasn't changed a whole lot. And it's similar for consumer discretionary as well.
Are there 3 characteristics in particular that you think make the perfect company that would make its way into your portfolio?
Really, as we look across the opportunity set, the 3 things that kind of stand out to us and the companies that are attracted to us, for the most part, sustainably high or improving returns on capital. We focus very much on are those returns sustainable or going higher? If they're going down and the company's investing at a lower return on capital, that's going to bring your multiple down over time. So that's extremely important. We look at the industry structure. Is it highly competitive? Is it healthy? Is it growing? And where does this company sit within that industry structure? And then management teams that have a strong track record in capital deployment. So if they're investing organically, have they driven returns higher doing that? If they're investing through M&A, what has been the outcome of the deals they've completed? And that just kind of sets the base for, the standards of the type of company we would own. Now, you can find those characteristics in a variety of businesses. They could be what you might call compounders, so just really consistent businesses that are in growing industries that aren't cyclical, and they deploy capital continuously and just compound earnings over time. They could also be cyclical businesses that go through an industrial cycle. Could be a trucking company, could be something else. But as long as they're continuing to deploy capital and that business is getting better and taking market share from peak to peak of their cycle, that can be something we could buy as well.
Okay, James, let's put that theory into practice. Can you take us through 2 examples that really exemplify those characteristics?
Sure. One of our top holdings is a fabless semiconductor company called Monolithic Power Systems. MPWR is the ticker. It trades in the US. and they make power management chips that increase the energy efficiency and reduce energy consumption of really a wide variety of electronic systems. Most recently, they've benefited from the AI trend that's been driving NVIDIA. So a lot of their chips go into data centers. They sit near the NVIDIA chips within those centers. So as those are upgraded and built out, they benefit from that. The company has very high gross margins, strong returns on capital, and they invest heavily in R&D and have for years. And with a 3 to 4 year time horizon between their R&D investments and when they actually gain revenue from those specific products, it gives you a long line of sight into the outlook on growth for the company over the next 2, 3, 4 years, not just the next 2, 3, 4 quarters. So it's benefited from AI trends recently, but it's much more than that. And their products go into any kind of electronics that you can imagine. Another stock we recently bought was Bayer, which is a Swedish HVAC distributor. It benefits from increasing energy efficiency trends driven by regulations. So the company has a strong history of deploying capital. In this case, they do it in M&A. So they're adding new product lines, they're entering new markets, but they're earning high returns on that deployment of capital over time, and they'll continue to do so in the future as well. And so again, these businesses can be cyclical, but if they're deploying capital at an attractive rate and you're buying them at the right time of the cycle, perfectly investable, for our strategy.
Last question for today, James. What role does the fund play in a portfolio?
Well, all of our strategies run the same exact process, and they're structured to drive returns through stock selection. And that's true for Global Smid as well, of course. So bottom-up fundamental research is the core of what we do, with a lot of things on top of that. Clients often think of us as a core holding within their equity allocations. So many clients will own a Smid as well as a large cap. It also adds great diversification to their portfolio as well. So now it's pretty easy these days to get large cap exposure through a passive ETF. It's fairly cheap to do that as well. So we have a number of clients that will use passive for large cap, and they'll use a fund like ours for an active manager in the Smid space.
Okay, well, thank you so much for your time today, James. It was a pleasure to speak with you and learn all about what's happening on the ground in small and mid caps.
Sure. Thank you for your time.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.